The world of stock trading can be thrilling and daunting. While technical analysis and fundamental understanding are crucial, trading psychology often dictates success or failure. Imagine this: you've done your research, identified a promising stock, and are ready to invest. Suddenly, news hits about a market downturn and fear grips you. Instead of trusting your analysis, you hesitate, only to watch the stock rebound later. This is the power and peril of trading psychology. We bring our own biases, fears, and hopes into every trade. Understanding how these emotions influence our actions is crucial for making rational decisions. In this essay, we'll dive deep into trading psychology, using examples from the Nifty 50 index. More importantly, we'll equip you with practical strategies to manage these emotions and make sound trading decisions. Trading psychology studies how our emotions and mental biases affect our trading decisions. Our actions are often swayed by fear, greed, hope, regret, and excitement. These emotions can cloud our judgment, leading to impulsive decisions. Imagine the stock market as a vast, ever-changing ocean. Technical and fundamental analysis provides us with the charts and compass to navigate this ocean. However, our emotions act as the unpredictable winds and currents that can throw us off course. A sudden gust of fear can make us abandon ship, selling valuable assets at a loss. Understanding the role of emotions in trading is not about eliminating them entirely, it's about managing them effectively. By acknowledging our emotional biases, we empower ourselves to make more rational, disciplined trading decisions. Remember, the market doesn't care about our emotions, but we must learn to master them if we want to succeed. Fear is a powerful emotion that can significantly impact our trading decisions. One common manifestation of fear in trading is the fear of missing out, or FOMO. Let's take the example of Tata Consultancy Services, a prominent constituent of the Nifty 50 index. Imagine TCS experiencing a steady uptrend, with its stock price consistently reaching new highs. News channels are abuzz with its stellar performance, and analysts predict further growth. Driven by FOMO, traders might make impulsive decisions, disregarding their initial trading plans and buying TCS at inflated prices. The fear of missing out can cloud their judgment, leading them to chase the stock's upward momentum without considering potential risks. The fear of missing out can be especially detrimental during market dips or corrections. When the overall market experiences a downturn, it's natural for investors to feel anxious. News headlines scream about losses, and analysts paint a bleak picture of the future. However, seasoned traders recognize that market dips can present excellent buying opportunities. While novice investors panic and sell their holdings, those who have mastered their emotions can capitalize on these dips. Consider again the example of TCS. Imagine the stock experiencing a sudden dip in price due to a broader market correction. Investors driven by fear might panic and sell their TCS holdings, fearing further losses. However, savvy traders who have done their due diligence might see this dip as a buying opportunity. By controlling their emotions and sticking to their trading plan, they can turn a potentially negative situation into a profitable one. Greed, the insatiable desire for more, is another powerful emotion that can significantly impact our trading decisions. Let's consider HDFC Bank, another heavyweight in the Nifty 50 index. Imagine a scenario where HDFC Bank is on a tear, experiencing a prolonged bull run with its stock price soaring to new all-time highs. The market sentiment is euphoric, with analysts predicting even greater gains in the future. As HDFC Bank's stock price continues its upward trajectory, greed can set in, prompting traders to chase the momentum. They may disregard their initial investment strategy, increase their position size beyond their risk tolerance, or even take on leverage to maximize their potential gains. This behavior stems from an irrational belief that the bull run will continue indefinitely, leading them to ignore warning signs and potentially expose themselves to significant losses. The allure of easy money during a bull market can be difficult to resist, but succumbing to greed can have devastating consequences. When greed takes hold, traders often become emotionally attached to their positions, holding on for too long in the hopes of squeezing out every last rupee of profit. However, bull markets don't last forever. Eventually, corrections occur, and those who have overexposed themselves to a single asset or haven't taken profits along the way can experience significant drawdowns. Returning to our HDFC Bank example, imagine the stock price reaching a peak after a prolonged bull run. While some traders might get caught up in the euphoria and hold on, hoping for further gains, savvy investors recognize the importance of taking profits. They understand that market sentiment can change quickly and that what goes up must eventually come down. By controlling their greed and adhering to their trading plan, they avoid the emotional roller coaster of chasing a stock to its peak and then watching their profits evaporate during an inevitable correction. Booking profits not only secures their gains, but also frees up capital to deploy in other potentially lucrative opportunities. Emotions can be formidable adversaries in the trading arena, but they're not insurmountable. By implementing practical strategies, we can mitigate their impact and make more rational decisions. One of the most effective strategies is predefining our entry and exit points before even initiating a trade. This involves determining the specific price levels at which we'll enter and exit a position based on our analysis and risk tolerance, not on our feelings in the heat of the moment. Think of predefined entry and exit points as our trading map. They provide clear guidelines and prevent us from making impulsive decisions based on fear or greed. For instance, if we're eyeing a potential investment in TCS, we'll first determine our entry point based on our analysis of its fundamentals, technical indicators, and overall market conditions. Similarly, we'll establish our exit points in advance, identifying price targets at which we'll take profits if the trade moves in our favor. This disciplined approach to entry and exit points helps us to stay the course even when emotions run high. Imagine a captain navigating a ship without a logbook to track their course, weather conditions, and crucial decisions made along the way. Similarly, in trading, maintaining a comprehensive trading journal is crucial for tracking our progress, identifying strengths and weaknesses, and refining our strategies over time. A trading journal is more than just a record of our trades. It's a powerful tool for self-reflection and improvement. It allows us to analyze our decision-making process, identify emotional biases, and understand how our psychology influences our trading outcomes. By diligently recording our trades, including entry and exit points, reasons for entering a trade, and our emotional state at the time, we gain valuable insights into our trading habits. By identifying these patterns, we can take corrective action, adjust our strategies, and develop greater discipline. Achieving consistent success in trading requires a holistic approach that integrates technical, fundamental, and psychological insights. Technical analysis provides us with the tools to identify trends, chart patterns, and potential entry and exit points. Fundamental analysis helps us evaluate a company's financial health, growth prospects, and intrinsic value, guiding our investment decisions. However, without understanding and managing our emotions, even the most sophisticated technical or fundamental analysis can fall short. By integrating psychological awareness into our trading approach, we gain greater control over our decisions and improve our chances of staying the course even when emotions run high. This involves recognizing our emotional triggers, understanding how fear and greed can manifest in our trading behavior, and developing strategies to mitigate their impact. By combining the objective insights of technical and fundamental analysis with the subjective awareness of trading psychology, we create a robust trading framework. In the dynamic world of trading, knowledge is power, but self-awareness is paramount. While technical and fundamental analysis provides the tools and insights to navigate the markets, it's our ability to manage our emotions that ultimately determines our success. Remember, the market doesn't care about our feelings. It rewards discipline, patience, and a rational approach. By recognizing these emotions, understanding their triggers, and developing strategies to manage them effectively, we can transform these potential pitfalls into opportunities for growth. By predefining our entry and exit points, maintaining a detailed trading journal, and continuously reflecting on our decision-making process, we gain greater control over our emotions. Remember, trading is not a sprint. It's a marathon that requires patience, discipline, and a commitment to continuous learning and self-improvement. By mastering our emotions, we master the most critical element of trading success: ourselves.